Russia, a global power, vast territory, abundant natural resources, and a leader who projects strength. From the Kremlin's golden domes to the pipelines that feed multiple continents, the world sees power and influence. But behind this image lies a fragile reality, one built on volatile oil, mounting debt, and a shell of economic resilience. This is not a story of triumph. It is a story of a looming fracture. In this documentary, we will take you deep into Russia's economy, past the propaganda, past the headlines, into the hidden cracks that few choose to examine. How long can Putin's strong economy truly hold? What happens when the foundations begin to crack? Over the next 2 hours, we'll explore the structural weakness of Russia's economic model, the impact of war and sanctions, the human cost, and what the future may hold for the world's third largest military power. On paper, everything looks stable. Russia's GDP, according to official state data, has shown periods of growth. The Kremlin touts economic strength, resilience, and self-sufficiency. But what is driving this growth? How much of it is real, and how much is a carefully constructed illusion? A major factor is oil and gas, the lifeblood of Russia's economy. The state budget leans heavily on energy exports. When times are good, the numbers shine, but the real test is when winds shift. Historically, Russia's wealth has come from its abundant natural resources. Oil and gas are not just export commodities, they are the backbone of the federal budget. According to analysis, the share of oil and gas in Russia's federal budget is estimated around 30% in 2024. But this dependency is a double-edged sword. When global oil prices are high, Russia benefits. When they drop, or when sanctions squeeze, the danger becomes painfully clear. As Western countries imposed sanctions on Russian oil, Moscow found a way to bend the rules. A so-called shadow fleet of tankers sails under obscure ownership, shipping oil to non-Western buyers. These workarounds generate revenue, but they come at a cost: higher insurance, greater risk, and substantial logistical overhead. Moreover, these tactics do not guarantee the same price that Russia once commanded, eroding profit margins. Despite clever evasion, the impact of sanctions and volatile oil markets is showing on Russia's budget. Analysis from Bruegel shows that oil and gas revenues dropped significantly year on year in 2025, and the budget deficit widened. In response, the Russian government is actually reducing its reliance on high oil price thresholds, lowering the, quote, cutoff above which extra oil revenues go into reserve. This is not just prudence. It's a signal that the Kremlin knows the high-price windfall days may be numbered. Since the full-scale invasion of Ukraine, Russia has faced a barrage of economic sanctions. These are not just symbolic. They target the very arteries of Russia's financial system. The Brookings Institution found that the heavy dependence on commodity exports makes Russia acutely vulnerable. The cost of these sanctions to Russia is much greater than to the sanctioning coalition, because every dollar lost bites harder in a smaller economy. One of the most crippling measures: financial exclusion. Russia has been cut off from crucial parts of the global financial system, making trade more difficult, capital harder to move, and cost of financing much higher. Reports point to hundreds of billions in Russian central bank reserves being frozen by Western nations. Without access, paying for imports, especially technology and sophisticated goods, becomes exponentially more difficult. Sanctions are not limited to banking. High-tech exports have been restricted. Critical components like semiconductors, aviation parts, and advanced machinery are now harder to acquire. This tech blockade undermines Russia's capacity to modernize its industry. Factories struggle, innovation slows, entire sectors risk stagnation. To survive, Russia's economy is turning inwards, to a shadow economy. Goods are smuggled via third-party nations, intermediaries, and semi-legal routes. But such trade is risky, costly, and unreliable. It's a patch, not a solution. For every tanker that dodges sanctions, there's a company paying a premium or losing quality. This hidden economy sustains, but does not necessarily stabilize, and it creates mismatches in supply, price, and quality inside Russia. The war in Ukraine has become not only a geopolitical conflict, it has become part of Russia's economic engine. Defense spending has surged, weapons factories hum, munitions are produced, and investments flow into military industrial complexes. While this drives GDP, it masks deeper unsustainability. This growth produces war machines, not consumer goods or long term wealth. To fund the war and mounting expenses, the government is leaning on monetary expansion. But as more rubles are printed, inflation follows. Some analysts warn that the real inflation rate is hidden, underplayed in official statistics. Essentials like food and medicine are rising fast for average Russians. Meanwhile, government debt is growing, the cost of borrowing climbs, and the ruble's stability, once a pillar of strength, is more fragile than many admit. While money flows into weapons, talent is leaving Russia. Developers, engineers, young professionals, many of the brightest minds are emigrating. A study of software developers found a marked exodus. Many moved to neighboring countries or obscured their locations to avoid detection. This brain drain is not just a brain loss, it undermines long term innovation, productivity, and the very future of the Russian economy. The war has also drained Russia's workforce. Beyond emigration, conscription, casualties, and a shrinking working age population create an economic burden. Factories may be working, but productivity suffers when key talent is missing. This demographic strain compounds the economic risk. For ordinary Russians, economic stress is real. Official inflation may not reflect the hidden spikes in key goods. Food, medicine, basic services all feel the squeeze. Meanwhile, wages lag and many households struggle to make ends meet. What was once a war economy is turning into a living crisis for many. Small businesses, always a bellwether for economic health, are dying under the weight of sanctions, currency instability, and import costs. Entrepreneurs cannot reliably import materials. Consumer demand is weak, and the government offers little buffer or support. The private sector is shrinking, leaving the state more dominant and the economy less dynamic. As economic hardship mounts, discontent simmers. Public frustration is rising in villages and cities alike. But in an authoritarian system, dissent is dangerous. The cracks in society may not yet be violent, but they are real. What comes next for Russia's economy? Experts lay out three possible paths. Number one, slow decline, a gradual economic decay as resource revenues wane, debt rises, and human capital leaves. Number two, sharp economic collapse, triggered by a major oil price shock, failure of shadow trade, or tightening sanctions. Number three, political rift or instability. Internal dissent, economic desperation, and elite fractures lead to political crisis and possibly a regime change or major reform. Could Russia reinvent itself? Theoretically, yes, with massive diversification, foreign investment, increased transparency, and a shift away from war. But in practice, political realities make meaningful reform difficult. War continues, sanctions loom, and the elite benefits from the status quo. Putin's strong economy is not built on indestructible foundations. It is tall, but it is hollow. The brand narrative of power conceals a fragile structure, one that risks cracking not with a bang, but with a whisper. The world must reckon with not just the weapons Russia wields, but also the economic tensions that could reshape everything. Thank you for watching. If you found this documentary insightful, please like, subscribe, and share. And leave a comment. What economic story do you want to see explored next?